The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Small Business Tuesday continues with Your Money, Your Call.
Hello, welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open and now's the time to give us a call on 1300 30 34 35, or if you prefer, you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we're very lucky to have John Athanasiou from Redleaf Securities and also David Buckland from Montgomery Investment Management. Well, we've seen the market rising this week. It's a good sign, and I guess a lot of people are asking, well, is this the end of the volatility that we've seen in August and September? This quarter, we do see a record amount of dividends being paid, over $20 billion. Is that going to be enough to support us to a Santa rally? Let's ask both our panellists. I mean, David, looking at the market, it's quite exciting to see good performances 2 days in a row. And I guess the question is, well, what are you doing in this type of environment? Are you buying up big? Are you still a little cautious?
Yeah, at Montgomery Investment Management, Julia, we're still a little cautious. So in simple terms, the market just about got to 6,000 points in very early March. It fell 1,000 points between early March and very, very late September. Got down to just a little over 5,000 points. So what it's done, it's rallied from a bit below 5,000 to roughly 5,200 points. So we've had 4 or 5 quite nice days, but the context is those 4 or 5 quite nice days are on the back of a 1,000-point fall. So we shouldn't get overly excited, but definitely it's nice to see a little bit of black rather than a lot of red. Let's not forget, a lot of that red was the result of a pretty rough reporting season. Not just the reporting season, but more the outlook from a lot of the companies. That was a fairly sober outlook from a lot of the companies. And more importantly, from Australia's point of view, commodity prices hitting multi-year lows on the back of the China slowdown.
Okay, so given that the earnings story is not looking to crash hot here in Australia, and certainly not in the US either, where earnings growth looks like it's peaked, and longer-term share prices tend to follow earnings, are you less positive about the Australian market?
What we've done at Montgomery is we've really selectively just spent a little bit of cash opportunistically. So, for example, Quadrant, who are a private equity firm, owned 18% of a business called Isentia. And some weeks ago, they divested that entire holding, exited it in its entirety. The stock fell back towards about $3.20. It had been trading at $3.50, $3.60. So we picked up a really nice holding at around $3.25. It's since rallied to $4. So we've been selective buyers of 2 or 3, I'll call them quite very high quality industrial companies during this period of severe weakness.
Very nice move. So Athanasiou, I think the stock code's ISD for anyone
that's
who's
correct.
Listening. And John, I mean, looking at the market, how are you advising your clients to be controlling?
Well, recently, you know, red is like the new black, so it's good to see a couple of few green days out there. The way we're going about investing our clients, our money, is having a bias towards bank stocks, the big 4. Essentially, I do believe that there's going to be a Christmas rally. As you mentioned, all that dividend money has to go somewhere and needs to find a home, and leaving it at the bank earning virtually nothing just doesn't make too much sense.
I mean, I guess looking at the bank yields, the big 4 banks are averaging a yield of 6.5%. That's compared to the 3-year bond yield, which is about 1.8%. So given that the bank's yields are looking so attractive compared to the cash rate, David, is that something that you'd support, even though there are some pressures on earnings at the moment and in terms of capital?
Look, I think it's a very difficult one to call. It's very difficult because the banks 25 years ago, 2/3 of their loan book were to businesses, and 1/3 with the household sector. And that, over the last 2 and a bit decades, has completely reversed. So it's now 2/3 are to the household sector and 1/3 to banks. And we know one thing about the household sector. Number one is they're highly indebted. Number two is that houses, as a value of debt and income, are off the Richter scale on the eastern seaboard of Australia. And so, by definition, the banks have a lot of exposure to the households who are highly indebted and to housing. So if housing either comes off the boil, which I think is a fairly reasonable probability over the medium term, or unemployment goes up, which I also think is a bit of a chance, then I think banks' long-term provision for bad and doubtful debts probably will rise. And if that is the case, it'll put pressure on their earnings. So all I'm saying is that's something to consider for people that just go blindly and say, yield of 6.5%, it's a lay-down misere. It may be, but it may not be.
Okay, so the yield's certainly looking attractive, but the earnings not so much. And I guess it's a question, a lot of these people have been in the bank since they first floated CBA at $5.40 and, they're never going to get out. No, look, they're a brilliant yielding asset at this point in time. But I'm just saying to our viewers, we should be a little bit aware that on occasions, typically 2 years in 10 or 2 years in 15, the bank's earnings do come under a bit of pressure. Absolutely. So we've got a lot of callers on the line, so let's go to our first caller of the night. We have Matt from Melbourne on the line. Matt, welcome to the show. How can we help you tonight?
Yeah, hi guys. Enjoy the show. The stock I'd like to talk about is Magnus Resources, ticker code MNS, and it's a stock that I've been following. Obviously, there's a number of graphite juniors out there competing in the same space. I just wanted to give you a quick rundown on them before you gave me some feedback. They've drilled their Natu tenements, and they've come up with a resource that has a mine life of over 40 years with an output of about 200,000 tonne per annum. But the main thing within the sector that I saw is their exceptional flake thickness, with 87% of their product in the large to jumbo, super jumbo categories. And obviously the larger the flake, the higher premium price you can sell your product for. Also, they have binding off-takes for 180,000 tonne of product with two major Chinese conglomerates. Finance has been approved, which is very much on the near horizon. That's about 180 mil to build their plant.
Matt, did you want to hear from us as well? We might just stop you there.
Guys, I just wanted to give you a rundown because, look, I know I've researched the whole sector, and there's a lot of things that scream out to me that this one is,
So it sounds like Matt is very, very bullish on Magnus Resources. So is the guy who sits next to me at work, who's been chewing my ear off about Magnus Resources. It has done quite well, although we have seen the share price pulling back over the last few weeks. So we might bring up Magnus Resources. MNS is the stock code there. You can see there was a massive rally up, and now we're starting to see the share price come away a bit. We know the story for graphite and lithium-ion batteries is a big one there. I guess for Magnus Resources, there are some upcoming catalysts to be watching out for, which is, finalisation of project financing, which would be a big one for the company. However, looking at this space, it is still a risky space given the world that we live in, but it is an emerging commodity. So what do you think, John?
I completely agree with you and with Matt from Melbourne. It is speculative, but if you have that risk appetite, I would argue Magnus Resources is probably the best one to be in that particular sector, in the graphite space. Their results speak for themselves. There's a reason why its share price is where it's at, and their grades are quite impressive.
Okay, so they did do a capital raising, $27 million in the second half of the year, and that was at 35 cents, and the share price after that just rallied once again. So it has been a difficult investing environment, but the shares have been doing relatively well. David, when you look at investments like this, what do you think?
Well, firstly, we don't look at
speculative.
We don't look at things like this because what we're focused on is businesses that make profit, and sustainably so. I'm not saying Magnus won't one day, but I'm just simply saying that until it can get the commodity out of the ground profitably, get it to port and get it to the customers and make money on it, For my money, it is sheer speculation. So, look, that's fine for some investors, but not for an organisation like Montgomery.
Okay. So Magnus Resources, it is on the speculative side, $140 million market cap. It has been doing extremely well throughout the second half of the year, despite that capital raising. Bell Potter also had a 58-cent target on it. It did reach a high of 58 cents, but now it's pulled away and 43 cents. So I hope that helps you out a little bit, Matt. Let's go to our next call. We've got Eddie on the line from Byron Bay. Eddie, welcome to the show. How can we help you?
Yeah, g'day. Thanks for taking my call. The stock I was just inquiring about tonight was Hansen Technologies, HSN.
Sure.
I bought it about a year ago at about $2. It's around about $3 at the moment, so I'm quite enjoying that. Enjoying that a lot. But I was wondering what you guys thought about where it might go from here. Whether maybe I should even top up some more, whether you think I should take some profits off the table on it.
Sure. So information technology, very small space in Australia, but this is a stock price chart that you want all your stocks to look like. This is what Hansen looks like at the moment. It just is, I guess it's got support at $3 and looking to potentially break out there. Looking in this IT space, is Hansen one that you like, David?
Look, it's a very well-run business. Andrew Hansen's been running it since the business was effectively listed, which must be now, I'm thinking about 15 years ago, and they actually made a few poor acquisitions early in their corporate life, and in fact had to have a very significant capital raising, believe it or not, at about 13 cents. So they have travelled from some distance from 13 cents of several years ago. So what they've done now is they've got a very, very strong recurring earnings stream. I think about 70% of their earnings is recurring. But what they have is they have many contracts in the billing space for telecommunications, gas, water, electricity. And they get a strong recurring earnings stream out of that. But the issue I have with it is that they're often quite small value contracts. So this one has been a bit of a game of inches. It's taken a long time for the market to appreciate how well the organisation's done. But I don't think you're going to get a sort of like a factor gain out of it. For our money at Montgomery, it's probably a little on the expensive side, but we very much like the management and the organisation.
Okay, so with a PE ratio of 30 at the moment, you think that, the share price has already pretty much doubled in the past year and that there's not too much to go.
It's a bit hot for us, Julia, yes.
Okay, sure. And John, would you agree?
I would have to agree. A PE of 30 means the slightest thing goes wrong, it'll dramatically pull back. It's a very well-run company. They keep on winning contracts. But, a PE of 30, that's quite pricey. So, yeah, I'd be, as you suggested, Eddie, I'll be taking a few chips off the table.
Okay, so founded in 1971, deals a lot in the utility space, the energy space, and now the pay TV space. But as David mentioned, 70% of its earnings reoccurring. But with a share price performance like that, you don't want just reoccurring revenue, you want extra growth as well. We will be back with more after this short break, but if you'd like to speak with our expert panel tonight, please give us a call, 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and you can email yourmoney@skynews.com.au. And we now have Pauline on the line from Victoria. Pauline, welcome to the program. How can we help you out today? Hi, Pauline. Do we have you there? Oh, I think we've lost Pauline. Let's go to our next call. We've got Vincent on the line from Melbourne. Vincent, welcome. What's your question tonight?
Yes, good evening. I had a question on the stock Info Media. I'm a long-term holder of that. I believe Montgomery Investment has also been a holder and backer of the stock. The stock is down 40% in the last few months amid the sacking of the CEO and a nasty boardroom challenge from the ex-CEO. I'd just like to ask David his thoughts on where the stock is going and his thoughts on the management.
Sure.
Thank you.
So this is Info Media. IFM is the stock code. Unfortunately, share price hasn't been doing so well. David, maybe you could tell us a little bit about the company and what's been happening in its boardroom and how it's been impacting on the outlook for the company.
Well, as Vincent said, it's come down from about $1.20 to sort of 70 odd cents. It's missed its earnings guidance a couple of times, and that usually in corporate Australia is sort of a bit of a death knell for the CEO. The CEO has recently resigned, and what has happened is the former CEO, who was on the board till November last year, who was also, I guess, the founder of the business and one of the great strengths behind the business's strategy, has now sort of tried to throw his oar into the water to some degree and get involved. The incumbent board is rejecting his overtures and sort of trying to call for a bit of a clean slate. And I guess with any of these situations, the share price has reacted negatively to that associated uncertainty. Our view is that it's a good underlying business that, if well managed, we'll look back and say this is a bit of an opportunity. But there's still a lot of water to flow under the bridge in terms of a new CEO, who that person will be, whether the board does settle down, and whether the big company does become well managed. Now, as I say, historically it's been a strong business, and we think it can return to that strength at some stage, but certainly not in the very, very immediate term. So buying it here in the low 70s, you're definitely putting your hand on your heart and hoping that the board gets the right CEO and things do settle.
And David, I mean, it is an interesting business. It's all about car parts, and they have sort of not only a catalogue but also a selling system around that, and data analysis, information research for the automotive industry.
Look, it's got a very high return on equity. It's got a very, very reasonably strong balance sheet, and up until missing its earnings guidance, as I say, on 2 occasions, I think it probably was one of those small caps. It's undercapitalised at about 225 million Australian dollars, but it was one of those small caps that I think people sort of said, I wonder if it'll go to the next level. And I guess that's one thing we've been wondering: will it go to the next level? And we're prepared to give it a bit of time.
Okay, so would you be accumulating more?
Yeah, I think, look, it's any time there's a lot of uncertainty, there's risk, and that's why the share price is weak. There is risk. And I think what happens is, as investors, you've got to make a decision: is this structurally flawed, or is it just temporary? And you don't really know. You're making the best educated guess you can, and our view is it's probably temporary rather than a structural flaw.
Okay. I mean, John, bringing you into this conversation, I guess the after-surface part of the car industry is a big one. We've been seeing record car sales for a number of years now. Is this a stock that you'd be buying into with the recent share price weakness?
No, I will not be touching this stock. Boardroom fights are for, real punters. Just wait till all the blood settles and then consider the business on its merits. It could get much uglier. You don't want to see any fights between CEOs and ex-CEOs. You're meant to be making investments. It's not meant to be a drama.
Okay, so that was IFM Infomedia. Let's go to our next call. We've got John on the line from Geelong. John, welcome to the show. What's your question tonight?
Hi, Julia. Yeah, earlier this year you suggested Yowie, which I've done really well out of, so thanks for that.
Excellent. Good to hear.
And I was just wondering where you think they might go to from here.
Sure. So looking at Yowie, really interesting stock. Who doesn't love chocolate and toys? Expanding throughout the US as well as Hawaii. I admit I did get out of this one because I was a little bit worried about the market, and I pretty much sold out of a lot. But the rollout of Yowie's is continuing over in the US. I noticed that Hartley's has a $1.49 target on the stock. So looking at chocolates and toys, and I guess they've been successful in the US because over here we have those Kinder Surprises, but over in the US they can't sell those Kinder Surprises because the toys in the chocolate are deemed a choking risk, whereas Yowie's toys aren't. So they've managed to do a trial with Walmart successfully, and they're rolling it out nationally now, not only at Walmart, but also some of the 7-Eleven stores in Hawaii, as well as in the US. So, John, what do you make of this?
I'm a fan of Yowie. I mean, the management has delivered. They said they'll deliver at the Walmarts, and they have. My only concern is Walmart is a very tough-fisted organisation, and they take their time to pay their suppliers. So it could be anywhere between 40 or 60 days. In light of that, I think from a capital management perspective, Yowie may need to raise some equity. I'll be watching that space. and then maybe if that does occur, then enter, or if you're fortunate enough to be offered that stock, maybe participate then.
Okay, so buying into the growth story. David, was it you that was saying that you got someone from your office to call up a number of Walmart stores in the US just to make sure that they were being stocked? There was someone I had on the show.
It wasn't me, but Walmart's a very interesting organisation. I think their revenue line exceeds $1 billion a day, US. So I think there's something like 6 to 8 times the size of Woolworths. But John's absolutely right. When you end up supplying an organisation like Walmart, you think you've won the lottery. But often you've got to really be careful, because what happens is that any supplier, and I do know one that was a major supplier in a particular item, they thought they won the lottery, and over a period of about 10 years, their margins just got slowly crushed by Walmart. Walmart have all the power ultimately, and unless you're producing something unbelievably special, they just slowly ratchet around the margins. So, you know, all I say is it does sound very, very exciting, but just be a little careful.
Okay, so be a little bit careful, sort of a double-edged sword. On one hand, great to get distribution at 4,300 stores, but on the other hand, once you have such a big supplier like that, that also becomes your largest risk as well. Let's go to our next caller. We have John on the line from WA. John, welcome to the show. How can we help you?
Yeah, g'day, Julia. Look, I was just reading about this company called Black Resources. They've got, they're going from being an explorer to producing the second quarter.
Sure.
Report, and they've got about 4.7 million ounce resource there. Their funding's in place. They're just going to the final feasibility study now, and they're an 80% open pit mine. I just wanted to know how they look on the chart, and there's been some good volume go through the stock over the last 3 weeks, and they've sort of pushed through their resistance, the highs in the last couple of days.
Sure. So looking at Blackham Resource, BLK is a stock. Go from memory, the share price has just rocketed up throughout the last week. There's the share price now looking pretty good there. Gold projects, Matilda as well as Wooloona. I think they have about 4 million ounces at the Matilda Gold Project. And gold stocks in general have been reaching yearly highs as well. So looking at Blackham, what do you think, David?
Well, I can't make any comment, John, on Blackham Resources, but what I can say is that what has in fact happened is that the gold sector did go through a bit of a hell when the gold price fell dramatically from approximately $1,700 an ounce to approximately $1,100 an ounce. And what happened was a lot of the gold companies really battened down the hatches, got their cost base down really aggressively. And then we saw the decline of the Australian dollar over the last few years from well above parity to approximately 70 cents. So what's actually happened is that their margins on the gold, on their costs versus the revenue have actually expanded quite nicely, and that's produced a lot more free cash flow for a lot of these producing companies. And I think one classic example is Evolution Mining, where we saw that the margin suddenly increased, by $100 to $150 an ounce in terms of free cash flow, simply because of the currency.
Okay, and John, just quickly looking at Blackham, it looks like they'll be producing second quarter of next year. They're looking at margins of about 500 Australian an ounce, so nice margins there. Is this a turning point for the company? Or?
I'd be very careful with Blackham Resources. When companies say they're about to get into productions, that's when things have a tendency to go wrong, particularly if they're first-time producers. So be quite conservative on this particular one.
And I guess that good news is already priced into the stock. So John saying being cautious on this one. And on that note, we'll be back with more after this short break. If you would like to speak with our expert panel, now is the time to give us a call on 1300 30 34 35, or you can always email us yourmoney@skynews.com.au. Welcome back to the program. Joining me on the panel tonight is John Athanasiou from Red Leaf Securities and also David Buckland from the Montgomery Fund. And I'm Julia Lee from Bell Direct. If you have a question you'd like answered, please give us a call on 1300 30 34 35, or you can always email us yourmoney@skynews.com.au. And we do have our next caller on the line, so let's go to Jason from Sydney. Jason, welcome. What's your question for our panel tonight?
Oh, hi, Julia. Thanks for your time. My question tonight is on ResMed and Flight Centre and where you see them going in the future. I hold both at the moment.
Okay, so having a look at ResMed and Flight Centre. Let's start off with ResMed. Really, it's just been moving sideways, I think, for the last 6 months. So if you can bring up the share price chart of ResMed, you can see it hasn't done too much at all. And I guess just having a look at the sleep apnea and sleeping device space, what we have seen is this market expanding. But I guess Fisher & Paykel over in New Zealand look like they've been increasing their market share. ResMed's still holding up. Would you be buying at these levels, John?
I'll definitely be considering picking up a few ResMed at these levels. I think it's a good sign that the stock has held up in a very volatile market, and it's definitely in a sector that's going to grow. Ageing population, you know, we all have these problems, unfortunately, with health-related problems, so you need a ResMed product as a preventative or cure.
I mean, and that's one of the problems with ResMed, David, is they had this trial and, you know, sleeping better and these devices were supposed to help with sort of heart events like heart attacks, but in fact the opposite was shown in this trial, and we saw a big drop in ResMed. It's recovered somewhat. What do you think of ResMed's future going forward?
I think it's a good future. I think it's, as John says, good demographics. They spend a lot on R&D. Fisher & Paykel Healthcare, yeah, they're a relatively minor competitor, but obviously a fly in the ointment. And then Philips subsidiary is their major competitor. But I like them as a business, and we think they've still got pretty solid upside from here.
Okay, so 2 yeses for ResMed. Well, what about Flight Centre? Now, we've seen profit downgrades hit this stock pretty hard. It has bounced from, you know, around that $30 level now to be $37. So a pretty steady, nice bounce of around about 20-25% there. Would you be buying at these levels? And I guess, John, you know, we always talk about the impact of the Aussie dollar, but Flight Centre has its international business as well. So it sort of gets the benefit of that lower Aussie dollar from that way. It's a little bit different in that it's still got bricks and mortar, and yet, you know, in the last few years, it's still been wildly successful before these profit warnings. So, are you buying into?
I think I like the company, but as soon as you hear a profit warning, you hear the alarm bells. So it's best just to, you know, sit it out until the company turns things around. You would think a low Australian dollar would benefit, but it also has the reverse impact of people not flying overseas as much and having domestic travel. So it kind of balances out.
Okay, so it sounds like a no from John. How about you, David?
Well, I'm cautious on this stock. I mean, I think it's been an incredibly well-run business, but, you know, the vast bulk of its earnings come out of Australia. And I feel that what's going to happen is there's a long-term challenge from the Expedias and what-ifs of this world on a global basis. And so bricks and mortar for travel, I think, is really... you know, it's going to be a little bit challenged. And as I say, they make the vast bulk of their earnings from Australia. And with the Australian dollar at 70 or declining, I just think at the margin, it'll be fine for domestic tourism, but probably not so great for international tourism, at least from a perception point of view. I think the other thing about overseas is that most overseas travel out of Europe and the States is generally relatively short-haul travel. And short-haul travel... people are just getting so much more used to just jumping online and finding the best deal, particularly if it's a flight for sub 4 hours. You know, you're just working out, you know, am I going, Ryanair or, you know, Budget Airways type of thing. And you just don't need the flight centres unless it's a long, complicated trip.
Okay, so it sounds like both our panellists cautious on Flight Centre. FLT is the stock code there. And I guess the Aussie dollar's been moving it around, but it has that international business as well, which is looking to expand by 6 to 8% in the current financial year. Let's go to our next caller. We've got Richard on the line from Sydney. Richard, welcome to the show.
Oh, good evening. I just got a question on the banks. If you're looking for the strongest yield possible whilst preserving your capital, are the 4 banks a good buy at the moment? Because, you know, I think they're averaging, if you average them out, you get a 6%, I think, at the moment. Would that be advisable, say, for someone that's retired and they're looking, they want to get above a cash rate,
sure,
but they don't want to. That they're worried about GFC2 around the corner. What do you suggest?
Okay, so I think a rather difficult question coming through from Richard, because there's two parts of that question. One's around the dividend yield, which obviously is very attractive, and the second part around capital preservation, which of course is a big question mark around. So if you don't like the banks in that sort of context, well, what are some alternative investments possibly out there? So, David?
Well, just to answer Richard's question, yes, they are yielding 6 to 6.5%, but the risk you're taking in acquiring that 6.5% yield is possibly decline in your capital. So I think since April, Julia, on average, the banks for a few months there declined by about 25%. So, you know, you need to buy them well to make sure that you're just not peeling off a lot of your capital. As I say, declines of 20-25% across the four majors in, I think it was about a 4-month period, you know, is relatively on the frightening side. The issue I have with the banking sector generally is that they've had this extremely good tailwind for decades in general terms, and that tailwind is starting to become a little bit of a headwind in terms of the regulatory requirements based on the capital, and also on a global basis based on Basel IV. They definitely need more capital, and they are very influenced by housing and confidence around housing and confidence around unemployment. So I just make the point that if unemployment goes up or housing falls or a combination of both, the banks may have to provision more aggressively for bad and doubtful debts, which they are relatively low in terms of their provisioning at present. And I just make that point that you've just got to be a tiny bit cautious about that prospect.
Okay, and I guess during the global financial crisis, we actually did see dividends going down for the banks as well. So it's not always just a one-way street where we do see rising dividends. It does depend on what's happening in terms of the market, as David mentioned, and it does tend to be cyclical. I mean, John, if not the banks, where else would you be looking for yield together with capital preservation?
Well, other sectors you could look at, and by the way, I'm actually a little bit more bullish on the banking sector, Richard. The reason being is I believe that they've recently raised equity and it actually strengthens their balance sheet, so they could potentially handle another GFC, and we're well aware that they're all government-backed. So I don't think there's any risk of them pulling back. Obviously, there is a risk that, you know, bad doubtful debts are increasing, but overall I do feel they'll be able to maintain their yield. Other sectors to look at outside of the banking sector, you'd be looking to a growing sector like healthcare or aged care facilities. There's stocks like Estia, ASX code EHE. That's an aged care play. I believe that's paying a relatively good yield of 4 to 5%. So you'll be looking at something like that.
Okay, so some ideas there. Yeah. I mean, one that I picked up recently was InvoCare at about $11. Yeah. It hadn't been doing so well because it's expanding over in the US and that's costing a little bit more money, but, you know, it's got a pretty good franchise. People are dying and, you know, they've got the prepaid funerals as well. So they're also managing money and they've made, you know, better than expected on their investment funds. So it's almost a fund manager at the same time as being a sort of a funeral seller. So that's my 2 cents. But other ideas in this space, David?
I think, Richard, it's the best idea is to focus on really strong businesses whose earnings are growing solidly over the medium to longer term, and the dividends will follow. And interestingly enough, you might buy something on a relatively low yield today, but if it's a great industrial company with great earnings growth, you'll look back 5-10 years previous and say, gee, what a beautiful yield on the price I acquired it at. And I keep pointing to M2 Telecommunications, which you know, 10 years ago was 30-something cents and paid out about $1.50 in dividends, and today it pays out over 30 cents in dividends. So based on the price 10 years ago, you're now getting a yield of 100%. You know, whereas Telstra 10 years ago, its dividends were roughly where they are today. Yeah. So buy high-quality industrial businesses whose earnings are growing solidly, and the dividends will look after themselves.
Okay, so really good point there. And I guess we were talking about the banks, and, you know, David, a lot of us don't remember the last recession in Australia in the early 1990s, but I believe back then there was talk of, you know, banks having real difficulty and perhaps not even lasting that recession.
Well, there was probably two of the banks were probably technically insolvent, and they had to have massive capital raisings. And this was where highly unusual circumstances. This was the recession we had to have. Commercial property in Sydney and Melbourne effectively halved.
Interest rates, double digit.
Very high interest rates, and they had finance companies that had lent very, very aggressively on property at around the top of the cycle. So what can happen is that they can get bashed up. They're actually highly leveraged businesses to falling property prices, as a simple example. So you've just got to be a little careful. It's not just one-way traffic.
Okay, so that was the banks and high-yielding stock. Hopefully lots of ideas there for you, Richard, to help you out there. Let's now go to an email from Greg, and Greg asks, I'm a long-term investor in CSR, but I've been watching the recent share price drop. Should I hold or should I cut my losses and sell? I mean, a really good question, CSR, and you'd expect, you know, if a building products company can't go up during, you know, a housing boom, when does it go up? And I guess CSR has been under pressure, John, because of its aluminium business, and it's, I guess, now a question of, you know, have base metals, have they bottomed out? But then is housing going to continue with the growth that we've been seeing? And what would your answer be, John?
Well, as you said, I think it's a real concern that stock that's related to the property sector is having quite a few difficulties. I'd probably be inclined right now to cut my losses and look at other stocks within that sector that can leverage off a growing property market. I mean, if they're struggling now, it doesn't really bode well going forward.
Okay, so it's a no from John. I mean, is this an opportunity? The share price has fallen so much now, David. Does, you know, it become worth taking the risk?
I think it's very easy to say when something goes from $1 to 50 cents to say it's cheap. But the problem is, if it's a poor quality business, it could stay cheap for a long time. And I think it's better to get your 50 cents and actually buy a high quality business. If it's a high quality business whose earnings are going to grow sustainably over the medium to longer term, that 50 cents will get back to $1. Whereas if it's a poor quality business, the 50 cents could go to 60, it could go to 40. You just don't know. But all you're doing is investing in relatively poor quality. And CSR's got a return on equity of about 6%, which is just substandard given the cycle.
Absolutely. So I guess it has been under a lot of pressure because aluminium prices have been falling.
But there's always been something with this stock. You know, it used to be a sugar company. They'd blame sugar, you know. It was building materials. It's aluminium. There's always something.
Okay, so no from David. CSR, it has been under a lot of pressure, falling from a high of around about $4.50 earlier on in the year to being at $2.70, so not a good performance there. We're taking a short break, but we're going to be back to answer more of your questions in just a moment. If you would like to speak with our expert panel, please give us a call now on 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to the show. If you have a question you'd like answered, please pick up the phone and give us a call on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. And we now have Nick on the line from Melbourne. Nick, how can we help you today?
Hi, I've got a question on two stocks. The first one is GEM.
Sure.
So I own GEM. It's been beaten up a bit lately for a number of different reasons, but I'm looking at it in the long term because of I like the industry and sort of the amount of cash flow that daycare brings in. So just a question on that, whether I should continue to hold. The next one is I don't have any miners in my portfolio, so given that there's so many other stocks that have been beaten down with their commodities cut in half, would BHP be something to look at?
Sure. So two very different companies, G8 Education and BHP Billiton. I guess we'll start off with G8 Education. It's a space that I'm very familiar with because I've been looking for childcare over the past 6 months for my daughter, Amelia. And I have to admit, it hasn't been as difficult as I've I thought it would be. You know, the city centres that are supposed to have a year-long wait, we've got into a couple with no problem around my area as well, ones that have had year-long waits. We've got into probably the top-rated one in a matter of months, and the rest, you know, no problems getting in. So I'm thinking, you know, childcare centres, it was so hard to get into for so long. And I asked one of the guys whose centres just opened up a couple of months ago, and I said, how long has this process taken you? And he said, you know, truthfully, close to 3 years to get all the approvals in place and get to that point of opening up. So it's a long period. And I guess when we think about the shortages at childcare centres, it's been a number of years now. So it does look like supply is slowly coming online. I guess coming back to G8 Education, though, its model is that roll-up model, and we've seen affinity with competition. It is a mature sector, but the share price has been absolutely pummeled. So, you know, below $3 is this an attractive proposition. It says a historical dividend yield of 8.2%, and that would suggest that the market doesn't believe that that dividend's going to be continuing at that level. David, what
I think with roll-ups, Julia, they work until they stop working. And what happened with G8 was they made a lot of acquisitions, and they were very strict about the multiple they paid. And suddenly they broke ranks and bought a lot of centres for a multiple that was significantly higher than their stated maximum. What then transpires is you tend to see with roll-ups a little bit of a fairly aggressive accounting, and the cash flows aren't often the same as the profits of the businesses they're acquiring. So we've been a little on the cautious side of this one, and we certainly haven't owned it for quite a long period of time. The second point to make is with roll-ups, you've got to be a little careful, because if they're paying, for example, an EBIT multiple of 4 times consistently, why, just because it's a publicly listed company, do you as shareholders pay 8 times or 9 times or 10 times when you theoretically could also go and pay 4 times, in theory? So you just got to be a little careful about paying double the multiple that they're paying and just giving them a free kick.
Okay, so are you generally against the roll-up model?
No, what I'm saying with the roll-up model is that often with roll-up models, particularly around people, is that you've also got to get the culture right. And sometimes when you're rolling up on the people side, it's too easy to for the vendors to say, I'll take the money and run, and I don't really like these new acquirers. And suddenly the acquirer doesn't quite know what they've bought. So you've got to be a bit careful on that front. But the more importantly, from my point of view, is why do we as shareholders pay twice what they're acquiring the underlying investment at? So we'll talk about it later, but it's a bit like an LIC. If the LIC's got an NTA of $1, why would we pay $1.50 for an NTA of $1? You know, it's just sort of a bit of a mathematical logic at times.
So really good points there. And I guess it would make sense if you were gaining economies of scale and that was giving you some sort of advantage. But something like childcare, which is so people intensive, where you need a number of carers and it's probably your biggest cost, the staffing part of your cost. While you do, you know, have some sort of economies of scale in terms of marketing and head office, the best marketing for a childcare centre is, you know, kids that are happy and parents that are happy, and that you can't really pay for in terms of posters and.
Well, Julia, I'm not going to argue with the mother's first real world experience there. You're absolutely right. I mean, you don't want to acquire for the sake of acquisition's sake. I mean, you've got to take your time when you make these purchases, and you're right, the economy scales are not really there. I mean, where are the economy scales? You know, these are located throughout the city. You can't put them all in the one same centre. The economy scales are like, you know, essentially admin and a bit of accounting work. And that's pretty much it, really. There's not too much there. So,
to tell you the truth, Nick, I actually held G8 Education until I started looking for childcare, and I decided no, I wasn't going to hold it. The other stock's BHP Billiton, and you know, what a time it has been for BHP. I mean, is this like gold miners a couple of years ago where no one wanted to touch them, absolute disaster, and then, you know, suddenly when nobody's watching gold anymore, it starts to have a really big rally. John, would you be buying BHP?
Listen, I like BHP. If I was going to get back into the resource sector seriously, BHP would be my obvious first pick. It's the biggest in the market and it's the most diversified. However, with all the going-ons with Glencore, I'd probably be holding off a little. I just want to watch that particular situation unfold and see what happens there. If Glencore goes into administration, that'll have significant ramifications to the resource sector. And, in the long term, it'll be to the benefit of the likes of BHP because they'll be able to get quality assets off the receiver. But in the meantime, you'd be watching what's going on with Glencore before you tip your toe back into the resource sector.
Okay, so just being a bit cautious given the volatility that we've seen in terms of Glencore. How about you, David?
Look, I'm going to stay cautious on BHP, Julia. So what we've got on our hands at the moment is coal's hitting 10-year lows, oil's hitting 6-year lows, copper's hitting 6 or 7-year lows, and iron ore is obviously hitting multi-year lows. And this is related to China slowing down to more normal growth. So I think we're going to look back at that period where iron ore was $150 a tonne and coal was 2.5 times its current price and the like, and say that period was actually abnormal. And our mining companies were actually earning abnormally high returns on their funds. And so what's happened is with something like BHP is their equity's gone from $30 billion to $80 billion. Their debt's gone from $10 billion to $30 billion. And they're earning less now than they did, several years ago. So these are not good businesses. The antithesis of the businesses we like to own, which is high return on equity and low cost of growth. And I agree with John, if you're going to buy a resource stock and punt China, bouncing, they're as good as any. But there's too many stocks who are on the bones of their backside all over the Western world at the moment that are really doing it very tough.
Okay, so that was G8 Education and BHP Bulletin, and it is now time for a short break, so we'll be back with more of your calls in just a moment. Welcome back to the program. I'm Julia Lee from Bell Direct, and joining me on the panel tonight we have John Athanasiou from Redleaf Securities and also David Buckland from the Montgomery Fund. So if you have a question you'd like answered, we're still here for another half an hour. So give us a call on 1300 30 34 35, or you can send an email to yourmoney@skynews.com.au. And we have Pauline on the line from Victoria. Pauline, welcome. How can we help you today?
Thank you very much. Look, I'm a bit of a new investor. I'm new into the stock market. I know that it's been quite volatile on the stock market. So I'm looking to invest in somebody told me invest in a listed investment company in LIC. And I'm looking for something that's got, I'm looking, I guess, for a long-term view and something a bit conservative and something that's got a proven track record. Is there, what would the panel, what would they recommend? Are there any around that I should have a look at?
Sure. So really good question by Pauline. And if you want the diversity in terms of your investments and you don't want to do it yourself, the listed investment companies certainly are an option, and there are plenty on the market to choose from. Now, John, I know at Redleaf you like to have listed investment companies and then some ideas on individual stock ideas.
Right.
So I might go to you first. You look at listed investment companies or LICs all the time. What do you look for, and do you have any favourites?
The two things that I look for is obviously the discount it has to its price, so NTA versus its current share price, and obviously the fund manager's track record. There are roughly 60 to 70 LIC on the ASX as we speak, and there'll be more and more as it becomes more and more popular. The two favourites that we have is CBG Capital, ASX code CBC. The reason why we like that one, it's trading at a slight discount and it's run very conservatively. It hasn't performed that well. Reason being is because, in my humble opinion, not many people are aware of this particular stock, but as time progresses and more people find out how well this fund is managed, the share price will probably reach towards, or it'll cut the discount.
I mean, it's a very small one, $23 million market cap. Why this one?
I've monitored quite a few of them. I think the discount is quite attractive, and Ronnie Chalmers, who runs the fund, is a
Sorry, wrong stock code. You're right. CVC is a lot bigger.
Yeah, it's much bigger than I was. Ronnie Chalmers, who runs the fund, is a very good fund manager, and he's got a very good team behind him. If you wanted someone with a larger market cap, you'd look at Argo. They've been around for a very long time. ASX code ARG. And if you've got a greater risk appetite, watch out for Aid Investment Partners. Now, they haven't listed yet, but they're about to IPO, I believe, around November, December. That's run by Mr. Stephen Walsh, who's got a very good track record in picking small cap stocks.
Lots of ideas. Sorry, CVC, not CBC. CVC has a market cap of $180 million, and it's been doing quite well over the last year. The stock's up 6.5% compared to the market that's lost 2.4% in that time. I mean, David, you don't sound impressed by LICs at all.
What I think, Julia, and this is particularly for Pauline and other viewers, is that usually a few years every cycle, they sell at a really good discount to what we call their net tangible asset backing. So if their net tangible asset backing is $1 and they sell at, say, 80 cents, then you're buying them at a very good discount, then it's worth having a look at. But to me, if their net tangible asset backing is $1 and they're selling for $1.20, I just think it's a mathematical logic to buy them. I just go and rather buy the $1 worth of shares. Yep. So I think you buy them at a discount, sell them at a big premium. The other thing I should point out is that the older LICs, the ones that have been around for decades, such as Argo, which John mentioned, and Djerriwarrh and AFIC, their fee structure is very, very, very low. But those LICs that have been listed in the last 10 years, generally, their fee structure is quite high. So my preference generally is to buy the older ones because of their much lower fee structure, and buy them those few periods every decade when they sell at a big discount to their net tangible asset backing, i.e. the 80 cents in the dollar, the 85 cents in the dollar, rather than the $1.20 in the dollar. Okay, so always buying a discount. I think that's what John was saying as well, and some ideas there. David, preferring the older ones like Argo as well as AFIC and Djerriwarrh. They're just their fee structure is very low compared with the more modern LICs. Okay, so having a look at the fees as well. So hopefully there's plenty of ideas there for you, Pauline. Let's go to our next caller. We've got Stephen on the line from Newcastle. Stephen, welcome to the show. How can we help you out today?
Yeah, hi guys. Look, I love the show, and you're all great. But look, I got into Stocklands and primary healthcare, probably at the top of the market. They're my two laggards in the in my portfolio. Look, all I want to know is what your view is in terms of 12 months going forward, you know, whether they're a hold, accumulate or should sell. They seem to be sort of underperforming at the moment, and just like your view. Sure. So looking at Stocklands, unfortunately the share price graph doesn't look so good with Stocklands. I mean, traditionally, you know, they have held things like shopping centres and retail centres, but I guess one of the things that Stockland also does is have a lot of land banks and residential development now, and that's a key risk if we do think that the housing market is peaking. So I guess your view on Stockland in terms of growth would depend on where you think, you know, property is sort of headed here in Australia. David, what do you think? Yeah, I think that's a fair point, and I think you know, that share price is telling us something. But for my money, you know, this is a relatively low return on equity business, and I just think you could probably you know, find much more solid industrial earnings, and with primary healthcare just sort of carrying on the same trend. You know, I do like the healthcare sector, but there's some healthcare companies that you know, they're basically commodity end of the business, and some are certainly not. So one that we own is Certex. It's a very high return on equity business. And primary healthcare is the absolute opposite. It's a low return on equity business. So I'd rather go for those high return on equity businesses with good growth, because they've got a bit of a moat around their business. They've got something
generally I think is sort of quite sustainable, and that is my personal preference.
Okay, so you'd be avoiding both of these stocks?
Well, that's just to me there's 1,850 stocks listed on the market. You only need to own 10 of them, and they're certainly two that I would classify as the also-rans rather than the 10 I'd be really focusing on.
Okay, how about you, John, looking at Stockland Primary?
Well, if you're a property company that's not able to perform well in this environment, when will you perform well? So it might be a good time to, unfortunately, cut your losses on that particular one, unfortunately, and move on elsewhere.
And what about primary healthcare?
Primary healthcare, I'm a little bit more bullish that primary healthcare may be able to turn things around, so I'd be a hold on that particular stock. I like the sector.
Okay, so looking at medical centres and pathology, you think that's a growing area, so I'll hold on primary, but it looks like both our panellists pretty negative on Stockland at the moment. Let's go to our next caller. We've got Michael on the line from Victoria. Michael, welcome to the show. How can we help you today? Hi, Michael, do we have you there? Hello.
Hi. First of all, fantastic show.
Oh, thank you.
I love the show.
Excellent.
Two questions.
Sure.
First, about ALU, Altium.
Sure.
And the second question for you, Julia. 1 week ago, we were 4,900 and everybody was talking, no, maybe we go to 4,700, 4,500. Everybody was very negative.
Sure.
Suddenly, in 3-4 days, we jumped to 5,200, like anything else happened before.
That's a good question. So let's start off by talking Altium. A really interesting company, looking at that software space, and it has, been doing really well over the past few months. It is a growth story there, and a lot of brokers are positive on it. I noticed that Bell Potter has a $5.25 target on it. The stock price just under that $5 mark at the moment. John, what do you think of Altium?
I really like Altium, but at these levels, I'd be taking profits. It's had a very good one. You could see the share price on the screen there. When something runs this hard, it doesn't take long for there to be a pullback. So I'd be quite happily taking profits there, Michael, on that particular one.
Okay, so taking profit. I mean, it is looking at double-digit growth, and double-digit growth is hard to find in a very slow growth world, which is why I guess Altium has been quite popular. But David, at these levels, would you be buying in?
Well, we like it. We're a shareholder in it. We've owned it for quite a period of time, and we've got a sort of valuation on it closer to $5.50, Michael. It ticks a lot of boxes. It's got a very high return on equity. It's got an excellent balance sheet, and it's got very good growth prospects. And it's selling for less than our assessment of its valuation. So for us, we like it. But I'd have to say, not that long ago it was $2.50. So the easy fruit's definitely been picked. And so unless we get a lot of new information, I would say that a large amount of the gain is now behind us, and it's less easy. Now, back to your question about 200-point moves. Look, at 5,000 points or 5,200 points, a 200-point move is a 4% move. And 4% moves up and down can be just pinned down to randomness. It can be sentiment, it can be what's happening to interest rates, it can be I'm feeling less bad about things. And one thing I should point out is that there's a lot of global mining houses that have fallen 80 or 90%. So they've gone from 100 down to 20, and they've bounced from 20 to 30, and everyone goes, oh, they're up 50%. But what you've got to realise is they're still down 70 from their peak, even though they're up 50. So these things, when they get so low, they can rally very dramatically from 100 down to 20 and back to 30. And suddenly everyone feels good because they've rallied 50%. They're still down 70% in total. So I wouldn't get too worked up about a 200-point move one way or the other. What I'd get worked up about is, whether these trends are sustainable over a period of a year or two or three, not, a period of a week.
That's a really good point, David. I mean, Japanese market over the last, few decades since the peak in the 1990s has lost 80% in terms of asset value from the peak to the trough. And yet, you know, some of the bear market rallies that we've seen have been stunning, 125% from 2003 to 2007. So you can see relatively quite big moves. And I guess it depends on your time frame and what you're looking for.
And whether you were lucky enough to buy around the lows or not, as the case may be.
Yeah, absolutely. And I guess, John, when we look at the market, we always talk about greed and fear that govern the market. And I guess at 4,900, it was very much fear. And now we've rallied it a little bit. People are getting a bit greedy and saying, I don't want to miss out on the run. Well, what are your thoughts around this?
Well, my thoughts are the markets have been excessively volatile, probably the most volatile I've seen markets. I'm of the opinion that the ASX will have a Christmas rally, and I'd be buying at these levels. And if you do see a down day, well, that's when you'll be picking up your quality stocks, such as your banks and so forth. I'd be predicting that the ASX will probably close around 5,700, 5,800 between now and Christmas. Reason being, you know, you've got the US Fed probably going to delay their cash rate decision till the new year, and you've got a lot of, as we mentioned earlier in the episode, a lot of dividend money coming through, which should boost the market.
Okay, I hope that helps you out a little bit, David. We are going to take a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the program. If you have a question about a stock or shares, our phone lines are still open on 1300 30 34 35, or you can email us, yourmoney@skynews.com.au. And we now have Andrew on the line from Melbourne. Andrew, welcome to the show. What's your question tonight?
Hi, Julie. How you going? Love the show.
Thanks.
My question for the panel tonight is on Northern Star NST.
Sure.
My question, I'm heavily weighted in this stock and got in at about 60 cents. Now, it's had a considerably good run.
Yes.
And for the last few years, the stock has continually announced positive announcements, increasing gold production, lowering costs, and I think has now minimal or no debt. In the medium to long term, considering the run the stock has had with gold coming off close to $700-800 US an ounce, where does the panel see this stock going with the factors that I've just mentioned in the medium to long term if gold gets back to where it was a few years ago?
Sure. First of all, congratulations, Andrew, on a great run in Northern Star, getting it at 60 cents today. The stock hitting just under $2.80. I must admit, I bought this early September and it ran 25%, collected the dividend on the way, and then I sold out because we have a minimum holding period for 1 month, and the guy who sits next to me bought in and he's been doing phenomenally well. The gold miners have just been on a tear, David. I mean, it was an Aussie dollar story, down 13% for the Aussie dollar over the past year, whereas the New York gold price down by 4%, and the Aussie gold subsector actually up by a massive 32%. But now we've seen the gold price starting to move in the US.
Well, we talked about it a little earlier with some of these companies that really saw about the March quarter, where they saw their margins expand quite aggressively because the declining Australian dollar was one thing. The second thing was they really got their cost base under control when they had the very hard times a year previous. So what's happening is with these stocks is I actually think they're a bit of a play now on the A dollar. And if the A dollar goes down, for example, another 10 cents down to 60, you know, that'll see their revenue line jump. Today's gold price jumped straight 15%, and a lot of that will drop straight to their bottom line. So to me, it's all things being equal on the basis that I have nil ability to predict the gold price, and I think most people have nil ability to predict the gold price. I think it's more you've got to work out where you think the A dollar is going, and if you're a bit of a bear on the A dollar, then I'd probably stick with it.
And remembering the market is forward-looking, so you want continued bearish assumptions on the Australian dollar for it to be priced into the stock. So I guess the market's expecting the A dollar to get about 65 US cents, but you want it to get even more bearish on the Aussie dollar for it to have a significant impact. I mean, phenomenally well, 150% over the past year for Northern Star. A lot of the gold miners doing well. Would you be buying in at this point in time?
Andrew, I just want to say congratulations again. Northern Star has been my favourite gold stock for a few years. The company just keeps on kicking goals. Everything they do, well, everything they say they're going to do, they achieve. They picked up a tenement that was unloved and they've absolutely turned it around. So that's very positive. Everything that the company can control has controlled well, but there are external factors that the company can't control, i.e. the AUD and where the bullion price is going. So on the back of that, I would call it a hold to, in your particular scenario, I would take out the initial capital that you put in, so you've got a free carry now. So whatever happens, you're still well ahead.
Okay, so a great run from 60 cents. And John, just talking about a potential strategy, taking out your investment, your initial investment, so that you have free carry in terms of the upside for Northern Star, and hopefully you don't sell out too soon like I did. Let's go to our next call. I've got Sam from Sydney on the line. Sam, welcome to the show. What's your question tonight? Hi. Hi, Sam. Do we have you there?
Yep, I'm here. I want to find out whether RO is better than SEEK, or which one do you prefer, the panel?
Sure. So I think the question was, do you think Xero is better than SEEK? So XRO is the stock code for Xero, and SEEK, SEK. So I guess both sort of in that IT technology space. One's making money though, and the other, will be hopefully making money. John, what do you think?
They're in the same sector but different businesses. If I had to choose one over the other, I'd pick SEEK. I think it's in a better sector, being human resources, over Xero. And the problem with Xero is they're not making money now. They probably will in the future, and it has a big competitor, i.e. being MYOB. So, watch how that battle plays out. But yeah, at this stage, Sam, I'll be picking SEEK over Xero.
Okay, so John going with SEEK. I mean, John mentioned MYOB, and this is one of those stocks that has just done so well this year. It's up more than 250%. The opposite performance of Xero, which is down about 25% over the past year. Which one would you be?
I'd also, like John, prefer SEEK. I think it's got less competitive tension. And what I see with Xero, it's not just MYOB. Reckon used to have a parent called Intuit, and Intuit are basically the global leader in this space, and they're coming back to Australia now. They've divorced or severed their relationship with Reckon, and they have an R&D spend that makes MYOB, Xero and Reckon look like a joke. So I think Intuit will become a serious competitor in Australia down the track. And as I say, they're the #1 player in this space globally. For my money, SEEK, its competitive landscape is really a lot lower. So I prefer SEEK. I also prefer SEEK at the prevailing price. So for us, it's about quality, prospects and price, and for us, that price thing is very important.
Okay, so David liking SEEK at these levels. So it looks like both our panellists behind SEEK and not with Xero. Let's now finish off with an email. We've got an email here from Dee who asked, I'm looking for a buy with growth opportunity, but would also like some income. I'm interested in A2 Milk or Telstra. What does the panel think of these two companies in the medium to long term? Wow, two companies that I have, so I'm interested to hear your response. I actually tried to get A2 Milk before it floated in Australia because it was trading in New Zealand. I thought milk prices are cyclical, they're so low. Surely they have to turn, and thank God they've started to show signs of life. A2 Milk's a little bit different. You can see that big spike up that we saw in terms of the share price. That's when there was some takeover interest from Freedom Group and another party earlier on in the year. The share price has managed to hover around about that 65-cent level. The growth for A2 Milk, though, is coming from its milk powders or baby milk powders at the moment, although they are also expanding in the US and they've been trying to expand in the UK for a number of years. So looking at A2 Milk, it's a little bit different from how some of the other dairy companies have been performing. For example, if you compare it to Bega Cheese has been moving pretty much with the milk cycle, the milk price out of New Zealand. Now that milk prices are have been going up, Bega Cheese's share price has been going up. So looking at A2 Milk, what do you think? Should it be priced more like a Bellamy's or should it be priced more like a Bega Cheese? What do you think, John?
I'd probably say more like Bega Cheese. I mean, A2 Milk, It's really going well because of the baby powder. At the end of the day, you see the prices on milk. You go to Woolies or Coles and they always have price competitiveness in milk. I think you're willing to skimp on the milk, but you're not going to skimp on your baby's baby powder. So that's where it's really, that's the reason why it's going well. But I will not be holding it at these levels. I think it's performed relatively well for what it is.
Okay.
And so I'll be pulling back my existing holdings.
Taking some profits off the table. Interesting way to look at it. David, how about you?
Well, with anything that's sort of agriculturally based, I think you've got to work out whether it's adding value or not. And you look at the return on equity, which is simply the profitability of the company divided by its equity, and you also make sure it's not got too much debt. But to me, that's a bit more of a commodity-driven company, as distinct we were talking about at Bellamy's earlier, where there's a lot of value add that's occurring. Back to telecommunications, I would prefer something like the M2 Vocus merger that's been proposed over Telstra, because to me, that business is going to have a lot of growth over the medium to longer term, whereas Telstra, its earnings today aren't greatly different to where they were 10 or 12 years ago.
Okay, and we've run out of time, so just very quickly, buy, hold or sell on Telstra?
Buy.
Buy. Okay, on that note, that's all we have time for today. Thanks so much to our guests for a fantastic show. John Athanasiou from Redleaf Securities and also David Buckland from Montgomery Investments. And to you, our viewers, for all your calls and emails. Until next time, I'm Julia Lee from Bell Direct. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.